Good morning, my dear students. Today we are going to talk about capital and revenue expenditure, right? So anyone who is investing in the market or those who are in the bank who are going to give a loan to a customer, you should evaluate the profit and loss account statement of a company, right? We all know that the sales or a turnover you can able to determine based on the product sold into price, right? But when you are looking at a expenditure, you need to be very, very careful what type of expenditure captured in the profit and loss account statement, because that defines the tax liability for the company, and also you can able to understand whether the company is placing it or capturing the right level of expenses to arrive the right level of profit. Most of the time, or the company trying to bring certain expenditure which is not revenue in nature in the P&L, right? So before we go and deeply understand what is revenue in nature, what is capital and expenditure, you need to understand what the purpose of this expenditure has been made. For example, the organization purchased certain machinery, plant and machinery for producing goods, right? So those we call it as a fixed asset, or there are certain expenditure which can be converted into a finished goods, can be sold in the market, that we call it as a revenue expenditure. So in a broader understanding or a broader definition for capital expenditure, any expenditure which is made for building up the businesses, maybe it is a one time in nature, not on a regular basis, right? So those expenditure which is form part of balance sheet, which can be claimed as expenses through a depreciation, right? So fixed asset is a capital expenditure. It is a one-time in nature, like a plant and machinery, computer, or printers, or any of the machineries, land, building. All these things comes under capital expenditure, which is not a regular in nature, which cannot be converted into a sales or cash within the span of 1 year. But in nature of a revenue expenditure, like a salary, rent, repair, maintenance, all these things are a cost of goods sold or wages. These are all called a revenue expenditure. They are revenue expenditure, a expenditure which can be converted into a or generate revenue within the span of 1 year. Right? Suppose if somebody purchased the fixed asset and claimed as a revenue expenditure in the P&L, your profit will show as a very minimal, or you can book a losses for the particular year. As per the accounting standards, that is a violation of a principles, right? So we call it as error of principle. You cannot place capital expenditure in P&L for calculating the net profit. So one should be aware of it in the P&L, what level of expenditure has been claimed, what type of expenditure has been claimed, whether which is related to the business operations. So then you can easily understand whether the profit is cooked up, or I should not say it is cooked up, or it is deviated from the norms or the accounting standard which is there. So that is very important point one should know before investing in the company, or before you give the loan to any companies or a partnership firm or a proprietorship firm. So arriving the net profit after deducting all the expenses is required lot of understanding, lot of go see through that, right? So the capital expenditure is a one time in nature, bigger in value, which is form part of balance sheet. It is not form part of a P&L, and it cannot be claimed as a revenue expenditure, right? And it is used for building up the businesses. All the capital expenditure can be claimed through a depreciation over the period of lifetime of the machine. For example, you purchase the machinery for 10 lakhs and used for 10 years, and you can claim 1 lakh depreciation under state line method every year, not as a 10 lakhs on the first year. If you claim 10 lakhs as a first year, what will happen is your profit will come down to the extent of 10 lakhs in the first year itself. You will end up in paying less tax on the particular year, and it will show as a loss to the organization. You may avoid taxes, right? So you need to be very, very careful placing the capital expenditure as well as the revenue expenditure. Revenue expenditure is smaller in value and which generate revenue on immediate basis, and you can keep it in part of operating expenses in profit and loss, right? So there is a big classification or a differences between capital expenditure and revenue expenditure. There are certain expenditure which is smaller in value, which generate revenue over the period of time, not in the same year. So those expenses is called deferred revenue expenditure. For example, you spend money for advertisement. Advertisement will not generate a revenue on an immediate year. For example, you put a big wordings in the main roads saying that you are open the one more branch on a particular bank branch in a particular area. Immediately, the people will not rush through for placing a fixed deposit or placing a savings account or current account or open a loan account with your bank. So that is a brand building exercise which will generate revenue over the period of time. But it is a recurring in nature. Advertisement and sales promotions are recurring in nature. So you may get confused with the revenue expenditure. Please remember, any expenditure which generate revenue on the same year, we call it as revenue expenditure. Any expenditure which generate revenue over the period of time, right? That is called deferred revenue expenditure. Any expenditure which is bigger in value, which will not generate revenue but help building up the businesses, that is called capital expenditure. In a much more layman point of view, I will just take a tea stall example. For example, if you are buying a the stove or the boiler for producing or making a tea in a tea stall, those expenses is called capital expenditure. When you are buying a milk and tea powder or a sugar to convert milk into a tea and selling it, that is called revenue expenditure, right? So the revenue expenditure like a milk and tea in the tea stall, you are buying it on daily. But when your capital expenditure like a the oven or a boiler is a one time in nature, which you are buying it for businesses which help building up businesses, and you cannot claim it as a expenses on the particular year unless until you depreciate it, right? So the definition of capital expenditure, definition of revenue expenditure is not constant. Please remember. For example, you are buying a AC for a training institute. It is called capital expenditure. The same AC which you are purchased for a Ratna fan house or a fan house which sells AC on a regular basis, that is called revenue expenditure, right? So the revenue or capital expenditure is not only just looking at a bigger in value or one time in nature. You should apply based on the application of particular the product or the businesses. For example, furniture mart who purchases the furniture's regular basis, those furniture purchases is called revenue expenditure. The same furniture is purchased by a other company which is doing a BPO, it is called capital expenditure. So the capital or revenue purely depends on whether it is form part of balance sheet or whether form part of profit and loss account. Suppose if you are purchasing the machinery or a asset which you are selling it immediately and generate revenue within the span of 1 year, that is called revenue expenditure. When you are purchasing a machinery or any other fixed asset which you are holding at and helpful for building up a businesses, is called capital expenditure, right? So you need to be very very careful by identifying this expenditure when you are arriving the P&L, right? That will help you to understand whether the net profit is arrived by placing right level of expenditure in the P&L, because the P&L is an important financial statement document which will helpful for giving a loan or making an investment in a company, or to understand the company whether the company has got a good track record in terms of sales or bottom line. So you can able to decide certain decisions, right? So when you are analyzing the P&L, what you need to do is each level of expenditure you go through that, whether the P&L has captured only revenue expenditure, all the capital expenditure is placed through a depreciation, and what percentage of depreciation is calculated. These are all the basic information as a person before deciding it whether the company profit is exactly arrived or it has been violated certain accounting principle, right? So this is very important for any student or any people who are investing in the stock market, doing a fundamental analysis to check whether the company is captured right level of expenses. Thank you so much. We'll capture on the next video, and those who are not subscribed our channel, please subscribe it. Thank you.